Good evening. Tonight is March 5th, and I'm going to be doing the continuing chapter 16 that I had started before spring break. I'm going to be doing a little bit of overlap, just so you have a little bit of review, because it's been, over 3 weeks now since you've done this. So I've passed the case. Sorry, it should say quiz 3, not quiz 2. So quiz 3, number 3, next Tuesday, March 12. It's on all of chapter 16, including what I did before the break and including what I'm going to do tonight. It's the same format as you're used to before. 8.5 by 11 double-sided formula sheet allowed. Open to whatever you want to put on there. The suggested exercises, hopefully, how many people have been using those? Good, because the TA put a lot of hours this summer into, and me too, polishing those up. We started with the instructor solutions manual, but it wasn't that great, and so we put quite a bit of work. We went through, I don't know, it's almost 50 pages, I think, and we went through 2 or 3 drafts and really polished it quite a bit. So this is an excellent a resource for studying. This is mostly a course it's more of a learn by doing course than it is, just store a whole bunch of stuff from the textbook, write a final exam, and then forget about it. This course is mostly about building up the kind of mathematical and finance skills that you're going to need in 3rd and 4th years. So you're going to learn a lot more from just practice, practice than you're going to do from just reading, the chapter and trying to memorize stuff. So, and that's a big resource, those suggested exercise. I picked those on purpose. I tried to, pick one from almost every topic that's covered in the course. On top of that, you also have the examples that are in the slides and also the notes, which is what I write on the board. Those are also available on my website, lemma.ca, and they're also available on CU Learn. If you don't have a textbook, the 7th edition is on reserve at the library, so you can, for the suggested exercise, you can go look at the problems at the end of each chapter if you don't have a textbook. And for the video, well, if you're here, you probably don't care, but the TA is going to do the video editing probably later this week or maybe on the weekend. I have just to bring a little bit of extra value into the course for people that actually bother to show up. I'd like to just give you a quick book recommendation, and there's an interview with the author. I'm not gonna play the whole thing, but I'm just gonna play a few clips. Basically, what I do for a living is I'm a sales guy. There's something unique about my business in that the inventory that we carry is companies for sale. And at the same time, it's good because I don't have to put up my own cash to have inventory. Right now, I have about $6 million worth of companies in my inventory, but it's not like I had to put up $3 million in cash and then sell it for $6 million. But what I have to do, what's unique about the Sunbelt business model is that we actually, in order to get paid, we actually have to sell twice. First, we have to sell to a seller to come and list with us, and then we have to sell to a buyer that they really want this company. And so we do quite a bit on sales skill training, and it's a real shame that in university it's probably one of the most important skills of a business, because what's the highest success factor for a business? Big sales, big revenue. What's the biggest failure factor for a business? Not enough sales, and there's not even a sales course. And so what this guy is, Jeffrey Fox, there's lots of business gurus. 99% of them, have nothing to say, or they have plenty to say, but it's useless. This guy really knows. He's by far the best author on the topic. And I discovered one of his books that it's about applying sales skills to getting a job. And so I have some for sale tonight myself, if you're interested. And I'm just going to play you a few minutes of his interview. and you have the link there. I tried it tonight. That's why, and I had some technical difficulties. It doesn't look like maybe that website is working anymore. So what I'm gonna have to do is just I put it up on my own website. So I'll fix up the slides and so let me just start. It's about 10 minutes. Oh, I have to go to this one.
Morning, Resume Bay Radio listeners. This morning I have the pleasure of speaking to Jeffrey Fox, who has written an outstanding book, How to Land Your Dream Job, and several other career development books. Jeffrey, good morning. How are you?
Good morning. I'm perfect.
So in light of unemployment reaching almost 11% in the United States, how can How to Land Your Dream Job help the person that hasn't had any interviews in 2 or 3 months, is barely scraping by on $400 a week unemployment?
Well, the book How to Land Your Dream Job is a marketing book. It's a book on how to market oneself to find and to get a job. And one of the things that your listeners should know is that most jobs out there are not even posted. In fact, many jobs are out there and the employer, the future employer, doesn't know they need somebody. So it's often up to the job seeker to create demand for his or her services. And everybody has his or her services, depending on where they work. So the listener should know they should not get the blues, should not get down. Getting a job is a full-time job. You have to work at it, set a daily schedule, do many of the things that are in that book, and they will definitely get it done.
Now you also have a section in the book where you got to figure out what your dollar value is. Can you tell our listeners how they do that?
Right. Well, first, let's start at the beginning. Why does a company exist? A company exists to get and keep profitable customers, or profitable patients, or profitable school students, or profitable parishioners. So that's why a company exists. Therefore, a job exists to do the same thing. A job exists to help the company get and keep profitable customers. And therefore, when people buy an employee, it's like a company buying a lathe or buying a piece of machinery. They buy the machinery for $10,000 and they expect that machinery to return to them the $10,000 plus some more money. That's the same thing with an employee. An employee is supposed to earn for the company 1, 2, 3, or 4 times their salary back to the company in the getting and keeping of customers, whatever job that might be. Everything is directly or indirectly related to getting and keeping customers. So if an employee pays you $20, you've got to demonstrate to the employee that you're going to bring in $30 an hour. They pay you $20 an hour, you bring in $30 an hour, or whatever. That's why employees hire people, to make money. And the employee has to demonstrate how they will help the company make money.
Well, also in the book, you recommend taking a very strategic, thought-out approach to your job search instead of the typical shotgun approach. Can you tell us what research is entailed in order to come up with a meaningful, impactful letter that you want to send to a president or CEO?
Well, or you can send the impact letter to somebody you know, from your research, that might say the vice president of marketing, the vice president of manufacturing, or something like that. You definitely have to go to the hiring manager and not to the personnel department or human resources department. So the first thing a person should do is identify where they would like to live, possibly. I mean, that's one route. Or what industry they might be in. And do that regardless of where they live. Then they do the research. They look at all the companies in that particular area. They go on the internet, they maybe visit the companies, read their advertising, look at their literature, get the product brochure. If they can buy the product, buy it, call the 800 number. In other words, you've got to do exhaustive research on the target company, always keeping in mind, if I were the company, knowing what I know about myself, why would I hire me? And so consequently, the job seeker is spending far more time doing research and planning on how they're going to approach the company and how they're going to pitch the company on their skills than they are sending out thousands of resumes. Most people do the wrong thing. They spend all their time networking and sending out resumes. Well, networking just gets you a lead. And if it's a lead something you're interested in, then you've got to do all the research. You know, what does the company make? How do they make money? Who works? What are their suppliers? And when you're doing that, you are then identifying a potential need. So you send a letter, an impact letter, not a resume. You send an impact letter to the CEO, the COO, the hiring manager, whatever. It says something like the fact, you got a wonderful company, I have it out in the marketplace, and there are 5 ideas to increase innovation. 1, 2, 3, 4, 5. It'll take me 5 minutes to explain how I can make those happen. P.S. or sincerely yours. P.S. I visited 5 of your retail stores. Perhaps you're interested in what people are saying about your new product. In other words, you've got to demonstrate to that hiring manager that you're a player, that you've been out there, you've done the research, you're thinking about his company, you've got some ideas, and the letter, the impact letter, is designed for the fellow to take or the gal to take your phone call, and in the phone call, you try to get an appointment.
Is it a good idea to send that letter before a phone call?
Yeah, it goes like this. Research to identify some needs, some problems you can help solve, to an impact letter that goes to the hiring manager. That impact letter is to tee up your phone call. You make your phone call, you reiterate your pitch in your letter, and remember you said I talked to 5 competitors, I talked to 5 customers, I talked to 5 retailers, whatever, and you've got the data you will bring along with you to the interview. It's management malpractice for the guy not to give you an interview, because he wants to hear what you found out about from the competitors and customers. So now you have set up your interview, and now you've got to do the pre-call planning as if it were a sales call, and if you did the sales call, you're selling yourself, of course, and now you've got a pre-call plan, what questions you're going to ask, what you're going to show, and all these different things that are required to make a perfectly good sales call.
Are there steps that someone can take to ensure that the person, the CEO?
So that's just a little bit of the recording. The interview is about 25 minutes long, so I played you maybe about 10 minutes worth of it. If the if that URL doesn't work, I'll put it up on my website. But basically what he does, it's genius. What that book does is he takes basically the basics of doing sales, which is you send a letter, then you call, then you get an appointment, then you go you prepare, then you go meet the person, and then you get a close. So basically what he did is he applied all the different skills of doing sales in a business-to-business setting. I'm not talking about like selling ketchup at like the grocery store. I'm talking about, when you go and you sell like aircraft engines, or you go and you sell, you're marketing, or you're maybe a snow clearing company, and you go and I want to have the contract for your parking lot. There's a certain method to it that works really well, and what that guy does is he shows you how to apply this method to getting a job. Because right now the market is very, very tough, and it used to be that I was lucky when I graduated in the mid-90s. It was the big .com boom. All you needed to get a job was a pulse. Everybody, we'll hire you. But nowadays, there's 10 people that go in. There's like maybe 1 or 2 jobs. There's like 100 people that send resumes. There's maybe 10, 15 interviews. So you got to be the one that just basically completely blows it away from all the rest. You got to differentiate yourself. Like everybody's down here, and I'm just like 10 times better. That's the person that gets the job. So hopefully that helps you with your career and in general sales. And if you want more, you can talk to me about it. I can give you a little bit more. Basically, all his books are amazing. So let's get back to the class. So before the break, I did 16.1, .2, and .3. I'm not going to redo .1 and .2 today. So when I talked about last time, break-even, EBIT, and earnings per share, and homemade leverage and deleveraging, that's, you can go on YouTube if you want to see it again. But what I'm going to do tonight is I'm going to start from 16.3, review it, because it's part of it's such a difficult chapter that I want to do it in 2 passes. So hopefully, you know, if I throw the spaghetti at the wall twice, it might stick. The M&M stands for Mogliani and Miller. And those were two guys that developed the theory of the capital structure of a company. So, you know, there's in a company there's some equity, there's some debt. How does that affect the value of the company? How does that affect the cost of capital? You know, what is the optimal point? So in here, the way that Mogliani and Miller developed their theory is a clever trick. It comes from science. It's used a lot, for example, in physics. You know, when you take high school physics and you learn about you know, forces and acceleration and so on, they say, well, let's just assume that friction doesn't exist because it makes things so much more complicated. So what these guys did is they said, okay, we're going to come up with a fake world, a theoretical world that's super, super simple. And then we'll figure something out in that. And then one at a time, we're going to put back some features into the real world until we get to a realistic model of how this works. So the two complications in a theory like this are taxes, because taxes, remember that going back to 2504, any financial instrument of any kind, a bond, a stock, a company, some real estate, whatever, what it's worth is the amount of money it's going to make into the future discounted back to the present. I mean, that's basic, like Chapter 5, Chapter 6 from 2504. Taxes complicate that cash flow. So since something is worth its cash flow divided by a discount rate based on risk, if the cash flows change, obviously that's going to change the value. There's two ways to remember that. If you take the simplest cash flow or a dividend divided by, say, a rate of return, if you want to increase the value of a company, you can do two things. Either you can increase the cash flow, or you can decrease the cost of capital. If you decrease, say if you decrease your cost of capital from 20% to 10%, when all of a sudden you're dividing by a smaller fraction at the bottom, so the value of the fraction is going to be twice as high. So to increase the value, you could double the cash flow, or you could cut the cost of capital in half. Actually, a better way to look at it in this case is this. So what these guys did, when you think taxes complicate things in both sides. They complicate things in what is the cash flow, because we're talking here about after-tax cash flow. So once you throw in taxes, that affects the top of the fraction. And also remember that in the calculation of the WACC formula, you have the cost of debt times 1 minus t, right? You go from the pre-tax cost of debt to the after-tax cost of debt. So taxes will affect both the top and the bottom of that fraction. That makes things quite complicated. And at the same time, you have bankruptcy cost. If you take on too much debt, there's an increased risk of bankruptcy. And when you go through bankruptcy, you lose quite a bit. You know, restaurant goes out of business, they'll be lucky to get 10 cents on the dollar for their equipment. 10, 15 cents is usually the kind of the building that I bought in Hull used to be a restaurant, and then when I was moving in, the restaurant, you know, used equipment guys were emptying out the place, and I remember thinking, I think that that's probably the only company that makes any money in the restaurant business, is just feeding on that, you know, used equipment and so on. So the more risk of bankruptcy you have, it makes things more complicated because you have these bankruptcy costs, these financial distress costs. So we're going to talk about that later tonight. So what the pure genius of Mogliani and Miller, what they did is they said, well, let's just create this world where taxes and bankruptcy doesn't exist. A company can never go bankrupt and there are no taxes. And then let's figure out some basic principles from there. And what we can do is one at a time throw back some what is called relaxing the assumption. Right? In the first case, you make two assumptions. Then in case two, what they did is just pull out one of the assumptions, and then what do we have? And so that's how they were able to build the complexity of that theory. Then the third step is to then throw in bankruptcy. So first, no tax, no bankruptcy, then tax but no bankruptcy, then taxes and bankruptcy. And the other thing you have to, that students confuse, is that there are, in the Modigliani-Miller theory, there are cases, which is what is the level of complexity, the level of assumption that you're at. And then there's the proposition 1 and proposition 2. So proposition 1 is about the value of the firm, so I'll call it present value, or I think in here they call it V in this chapter. And proposition 2 is about what is the cost of capital. So what you have is case 1, proposition 1 and 2. Then you have case 2, proposition 1 and 2. Then you have case 3, proposition 1 and 2. So that's what I'm going to build one little block by one little block until we get to the end of today. I had started before the break. I had basically gotten, I think, to the end of case 1, the no tax, no bankruptcy, a simple case. But I'm going to go through it a little bit quicker because it's review, but it's been 3 weeks. Some of you were away for spring break, probably having lots of fun. So let me, there's a little bit of overlap, maybe 10 minutes, but I think you need the review. So the first, so now we're talking about case 1, which is the extremely simplified world. And we're talking about proposition 1, which is what is the value of the company. So in this case, the role of the cash flow is EBIT. Right? It's the earnings before interest and taxes. And that's divided by RU, which is the, instead of using WACC, because we have so many different returns in this thing, it's the textbook uses R and then a subscript to say what is the cost of capital. So you're going to have RU, which is unlevered. Remember that debt is leverage. We talked about that in the beginning of this chapter. So when you say a company is unlevered, it means it has no debt. It's an all-equity company. 100% equity, 0% debt. So the value of the unlevered firm is the EBIT divided by the unlevered cost of capital, which is the same as the value of the levered firm, which would be equal to the equity plus the debt. And that was the first little, spark of genius that they had. Here's what they came up with, what they figured out through doing this, is that when taxes don't exist, so this would be the debt to equity ratio is 0. The weight of equity is 100%, and the weight of debt is 0. Remember that there's 2 ways to express the capital structure of a company. You can either give the 2 numbers, the weight of equity and the weight of debt, or a more compact way of expressing that is as a debt to equity ratio. And the debt to equity ratio goes from 0, it doesn't go up to 1, it goes to infinity. Because, sorry to give you some calculus flashback there, but if you think a company always has some equity. You could have 1 share for $1. You could have 1 share for 1 cent. and then have $1 billion of debt. There's always at least one share. That's the way that the English common law setting up corporation system works. You always have at least one share. But as you have more and more debt, it's not that the debt to equity ratio goes to 1 or 100. It's, imagine that you have $1 billion worth of debt and you have one share equal to $1. Well, then in that case, the debt to equity ratio would be equal to 1 billion. It wouldn't be equal to 100% or 1. So when a little bit later, we look at graphs like that, where the x value is the debt to equity ratio, it doesn't actually stop on the right. It just keeps going forever. Obviously, once you're at 99% debt and 1% equity, the odds of your company going bankrupt are so high, because if the value of your assets goes down by 1.1%, your equity is wiped out. So what Magliani and Miller figured out in case 1, proposition 1, is that it doesn't matter how you split the pie, how you cut it. It always has the same size. It's not that it goes like this. When you have equity, just all equity, it's worth this much. Then when you have more, then it's worth that, and then it's worth that. It's that in the absence of taxes, the pie is always the same area, no matter how you split it between debt and equity. This is a little bit more clear than the way they show it in the textbook, because you go from unlevered to debt to equity. This is, by the way, debt to equity of 1, which is the weight of equity, weight of debt is each 50%. That's about the maximum that banks will do deals at. I actually met the VP of Royal Bank today, and for commercial banking in Quebec, and what she was telling me is, for them, that's an absolute brick wall. They won't do a deal where, if you're a company, say, buying equipment, and you're buying $100,000 of equipment, they'll never loan you more than $50,000. So that's a pretty strong. That's for a commercial bank, what we call a Schedule I bank or a chartered bank. BDC, which is the government kind of half bank, half economic development agency, they'll go up to 3/4 debt. We'll even get close to that line of 3, they'll get nervous. So yeah, it's possible to have, theoretically possible to have debt to equity ratio above 3. But in the real world, if any kind of bank financing or government financing is involved, commercial banks will stop at half debt, half equity, and BDC will stop at about 3/4 debt, 1/4 equity. But even then, they're like, don't make it. What the director had told me was, don't make it 3, make it like 2.8, 2.9, or something like that. So these are the capital structure that real companies operate under. What Magliani and Miller says is, when you don't account for taxes, the value of each is, it doesn't matter how you split it, it's always worth the same. That's what that equation says there. I'll do this example quickly. Yeah, that's for BDC. I've done this example before, but I'll just do it quickly so you can see how this works. So we have a company that's an all-equity firm, meaning it has no debt. It has 500 shares of stock, and the company will borrow $8 million at 9% to repurchase 200 shares of the outstanding stock. So what's happening is this. Right now it's got 500,000 shares. It's all equity, and it's going to go to 300 and 200. I'm not sure if I'm splitting it quite right. Yeah, 300 shares of equity, and then what they're going to do is buy back 200,000 shares of debt. This is what is called a capital restructuring, and it can go both ways. If a company has not enough debt, and you'll see in a moment, you think, especially in, you've been raised in thinking about personal finances. In personal finances, debt is almost always bad, except to some extent mortgages. But the most stupid thing that people can do is not have their mortgage paid before they're retired and think that they're going to use their pension check to pay the mortgage. Obviously, this is not a problem that you're going to have for a long time. In a company setting, there is a certain amount of debt which is healthy and which actually helps. Because what happens is, say I talked about that the last time, say I buy a house for $100,000 and then I'm making $10,000 in rent on it. Well, if I instead go and I borrow $50,000 of that, so my investment is $50,000, I'm still making the $10,000 in rent. Then I have to pay the interest, maybe say $2,000. So I'm making, is it $8,000 over $50,000? That's a much higher return than the unlevered return. That's why that is called leverage, because what it does is it juices up. It works like a magnifying glass on the return to the equity holders, the shareholders. So what happens with firms is, over time, they drift away from what they should be. Company, things doesn't go too well, and they end up piling on a little too much debt. Or the other way around, you figure out after a while there's too much equity. It would make more sense to have the bank finance some of the company. And what you can do is two things. When you lever up, meaning you're adding debt, what you do is you borrow money and you buy back some of the shares. So you increase the debt and you reduce the equity at the same time. The other version of capital restructuring is the other way. It's unlevering. So if a company has too much debt, what it does, and that happened with the banks in the financial crisis, they had to go and sell new shares. They had to raise new equity. Then you take that equity and you pay back some of the debt that you have. So that's a unlevered capital restructuring where you're taking some of the debt and you're converting it to equity. In this case, this is a leverage up restructuring where they're going from no leverage, debt to equity of 0, all equity firm, and then they're going to put on $8 million of debt. So the debt's going to be equal to $8 million. And they're going to use that to buy back 200,000 shares. So the price today, if the company is worth 8 million and you have 200,000 shares, then each share is worth $40. And so the value unlevered of the company before you do this restructuring, the value unlevered is going to be the amount of shares that you have when you're unlevered times the price. That's going to be 500,000 shares at $40, which is 20 million. So you can see that when you're unlevered, you got 20 million. Then when the company is, after it levers up with this restructuring, you end up with the equity in the levered case, which is going to be the 300,000 shares plus the debt. So you have 300,000 shares. They're worth $40. So that's this part here. and then you have 8 million of debt. So the total enterprise value, remember, there's probably 5 or 6 different ways of expressing that. Some people call it enterprise value. This book calls it sometimes just value of the firm. There's also, I've seen MVIC, market value of invested capital. All of these things mean the same thing. It's all the market value of the equity plus all the market value of the debt put together. Well, you can see that in this case, after you redid the restructuring, this part's worth 12 million, and the debt's worth 8 million. And you can see that it's the company as a whole is still worth the same amount. So that's the key insight of Mogliani and Miller and how they started building their theory. So what they said is, first, when there's no taxes, the value between unlevered and levered doesn't change. Okay, so once we get into with tax, what they did, okay, so now introduce tax. How does that change the value of the levered company? So we're going to get to that in a few minutes. Already talked about that. So in case 1, the value of the firm is not affected by changes in the capital structure. Doesn't matter how much debt, how much equity you got, it's always worth the same, since the cash flows of the firm do not change. And proposition 2, which is about the cost of capital, the cost of capital is not affected by the capital structure. So remember that in chapter 14, where you have the cost of capital, you have the weight of equity times the cost of equity plus the weight of debt times the cost of debt times 1 minus t to convert to after tax. And so if you transfer more of your stuff to debt where it has a lower percentage, obviously then the weighted average of the thing is going to go down. What those guys are saying is, in case 1, in this simplified world, this doesn't happen. It doesn't matter what amount of debt or equity you have, the overall average is always going to be the same. So that's how they write the weighted average cost of capital. Remember that there's no taxes now, so the equation from chapter 14 that you saw in 2504, which is this one, if I could find it. Right, the average cost of capital is the weight of equity times the cost of equity plus the weight of debt. Right? You're familiar with that. That's what you saw in chapter 14. So you might have wondered, maybe not, where it came from. It came from those two guys, Mogliani and Miller. It's their case 2, proposition 2 equation. Because in 2504, we just try to make it really simple. So it's just, this is the equation, just don't worry about it. And then in 2505, we try to teach you, well, why is it that equation? And so if you take that equation for the average cost of capital and you rewrite it in terms of, you just do some high school math and you shift things around to get the cost of equity, then you end up with the cost of equity is the cost of assets, or RA and RU is the same thing. And then the more debt you have, the more the cost of equity is going to go up. It's a little bit counterintuitive, but here's what's going on. So remember that debt is senior to equity in the capital structure of a company, meaning that when there's cash flows coming into the company, the debt holders, the bond holders, the bank loans, other liabilities would be government taxes, employee salaries, all those things. They have a higher precedence than the equity does. And so the debt holders have to be paid in full, all their interest payments and all their principal payments, before the equity holders are allowed to get $1. So what happens? When you have an all-equity firm, it's a lot less risky from the point of view of the equity owners because the money goes to them. There's nobody that has to get paid in front of them. There's nobody senior. In an all-equity firm, there's nobody senior to the common share. There might be some preferred shares, but say there's just common shares. There's nobody in front of that. What happens is, as you have more and more debt, the equity becomes more and more risky because there's more and more people in front of you that have to get paid before you get paid. And if the company shuts down, either through bankruptcy or a liquidation, then say there's 10 million of debt and there's $8 million worth of equipment. Well, common shareholders get nothing. Right? If say there's $15 million of equipment that you can sell, then the debt holders get their 10 million, and then the 5 that's left then goes to the equity holders. So you can see that the more and more debt you have in a company, the smaller and smaller slice of the pie that the equity holder has, and they're last in line, the more and more risky it is, and therefore the cost of equity is going to go up. So that's what it looks like. But here's the key, the second key insight of Mogliani and Miller, is that the average doesn't change. Because what they did is they took the WACC equation and they flipped it inside out to get what the cost of equity is. So obviously the average is not going to change because that's where the equation comes from. It's by mathematical definition is set up that way. So if you think of, say, the cost of assets, I have one where there's some numbers. Well, we'll show an example in a sec. Let's say the cost of the overall cost is 10%. Then you could have, say the debt was 8, and then the equity would be 12. Right, the average is still 10. Now, when you get to a quarter, say, here's the key thing: the cost of debt, or at least in their theory, in their fake little world, the cost of debt doesn't change. In reality, the more and more debt you have, the more and more, the higher and higher percentage you're going to pay. But for the purpose of the course right now, the debt stays the same. In the real world, the way it works is, for example, at BDC, if you do a deal, say at a debt-to-equity ratio of 1 or below, they'll give you 5-6%. But if you want to do a deal at a debt-to-equity ratio of 3, they're going to charge you 8, 9, or 10. So, yes, the theory from 1952 or whenever those guys wrote their article says it's flat. In reality, the real world is never as simple as it looks in the textbook. But for what we're doing here, no matter how much debt you have, the price of debt never changes. It's always 8%. But you can see that to keep the same average, but you have a smaller thing, I'm not sure, that would be maybe, have to say it's about 15 or so. And then, once you get to an even bigger amount, then that would be maybe the cost of equity here would be maybe something like 30%. So you can see that as you have more and more debt, as you move to the right of this picture here, the average stays flat, the cost of debt stays flat, but the cost of equity shoots up, so that the weighted average cost of capital between the equity and the debt always stays the same. That's the insight of Mogliani and Miller case 1, proposition 2. It says it down there. So I did that example last time. I'll go over it a little bit quicker. So you have your return on asset, the ROA. By the way, RE, for, this is a finance thing. For the accountants, that's the same as ROE, what the accountants call ROE. In finance, it's called RE. And what the accountants call ROA is what finance people, or at least in this textbook, called, it's either RA or RU. For return average or return on levered. So in this example here, when the debt to equity ratio is equal to 0, the return on assets is 16%. The cost of debt is 10. And the percent of debt is 45. So that means the debt to equity ratio is 0.45 to 0.55, meaning what's that, about 0.9 or so? Right, at this same point, the weight of debt is 45%. So at this point, the cost of equity has gone up to 20.91. And then this would just keep going on. Okay, then it says, so the first one is, just plug in the numbers. You know your x value, just figure out what the y value in that equation is. The second one is, that the cost of equity, it's that happens a lot in this course where there are always pairs of problems. There's one where you do basically the thing one way, and then there's one where you do it the other way, same as the restructuring. In this case here, there's, I give you the debt to equity ratio, give me the cost of equity. The second part is I give you the cost of equity, 25%. Tell me what the debt to equity ratio is. So it's just a matter of still using the same equation, plugging in the numbers, but now you're solving for debt to equity ratio instead of just figuring out the cost of equity. So here, in this case, the debt to equity ratio would be 1.5. So that's what, about 0.9. And then based on this information, what is the percent of equity in the firm? Remember I gave you, it's not in the textbook, but I gave you this, what I would call, I don't know, utility formula, that the weight of equity is 1 over debt to equity ratio. So you can just rewrite this as 1 plus debt to equity ratio is 1 divided by weight of equity, and then take the 1 on the other side. So again, this is, like I told you, there's a lot of these mirror pairs of stuff in this course. So this is one side of the mirror, and that's the other side there. So this is how you go from a debt to equity ratio to a weight of equity, and this is how you go from a weight of equity to a debt to equity ratio, which is what the last thing at the bottom is. 1 divided by 2.5, but it's really 1 divided by 1.5, and then they take minus 1. So how does the financial leverage affect systematic risk? So another part of what is called modern finance, but it's not that modern anymore because it happened between the 1950s to about the 1970s, 1980s. all these different theories that you're learning in business school right now, they all come from around that period. You know, you have Mogliani and Miller in 1951 or 53, I think. Then you have the CAPM around that time too, I think late 50s, early 60s. You have the Black-Scholes option pricing formula. We don't do that in this course, but you're going to, if you keep on taking finance courses, you're going to see that over and over again. For example, like if you're a company and you're doing employee stock options, you got to report the value of those stock options on your financial statements. You got to use the Black-Scholes formula. Then there's another one called, it's HJM, but I never remember the guy's name. It's J something, and I think Moros. Those are the guys that came up with the theory of interest rate and the term structure and so on. So that put together is what is called modern finance. So the CAPM, which we talked about in 2504 a little bit in this course, is the cost, the return on assets is composed of two components. First is a risk-free return that everything gets. Doesn't matter how risky, like this is basically a base. And it's usually the interest rate set by the central bank of the country, which right now in most of the world, RF is essentially zero. RF has actually two components. It has the inflation and the real part. Right now, the RF is essentially just inflation in most countries. It's, you know, if you take, for example, in the U.S., the 10-year government bonds at 2%, and the inflation's about 2%. So the risk-free rate just evens things out, just compensates you for inflation. You're not making any real return. Anyway, that's a risk-free rate. We talked about that in 2504. Then, for every investment, that was the what the CAPM people figured out, is you take the beta, which measures the risk of something, and it's a regression of the returns of your stock or other asset versus some kind of benchmark, RM being the market. And it's not beta into the index of the market. So if you're talking about, say, Canadian stocks, RM would be the return on the TSE or Toronto Stock Exchange Index. It's not beta multiplied into the return on the index. It's beta multiplied onto the return of the index above the risk-free rate. Right? It's a spread above the risk-free rate, and then beta is a magnifying factor there. So beta measures the risk of the company's assets. If you replace in the equation you basically match up the RA of the CAPM with the Mogliani and Miller equation, and what you end up with is this equation here. And the part that's important is what's in the middle right here. So, they go through how you get to it. But what's really important is this equation right here. That the beta of the levered equity is what the beta of the overall assets of the company are. So basically based on their operations, what they're doing in sales, products, markets they're in, that kind of stuff. The business risk. And the overall risk of the stock is composed of two components. The basic risk of the company, business risk, there might be some new competitors, you might have a strike, all these kinds of things. And it's multiplied by a leverage factor, which is 1 plus the debt to equity ratio. So you can see that when you have no debt, so the debt to equity ratio is 0, then the beta of the equity, the risk of the equity is the same as the risk of the overall company, because that's what's going on. You've financed the whole company using equity, so the return on the whole company should be the same as the return on equity. But, and this is the reason why it's called leverage, the more and more debt you have, it acts as a magnifying glass on the risk of the equity, what I talked about earlier. So the more and more debt you have, the more and more risky the equity is, because you got a smaller and smaller slice of the pie, And everybody in front of you on the pie has to get paid before you get anything. So the risk of the equity is composed of two things: the business risk and the financial risk. So the basic attributes of a business: it's sales, it's customers, it's employees, all these kinds of things, competitors, multiplied by the additional risk that having debt brings. I did that example last time. It's just plugging in the numbers, so I'll skip it. I'm just kind of doing review. I don't remember if I did this one, but I'll just, so you really understand that whole understanding that the risk of the shares of a company are composed of two things: the overall business risk multiplied by the debt. That's an important concept. I'm just going to quickly redo this example as a review, so you know. So the beta of the equity is going to be the beta of the overall assets times the leverage. And so in this case, when the company has no debt, the beta is 0.95. And now the company has, here's another way of going from a weight of equity to a weight from a weight of equity and weighted debt to a debt to equity ratio. If you think, right, your debt to equity ratio is you just take the weight of debt divided by the weight of equity, right? If you have 60% debt and 40% equity, that's the same as saying you have 0.6 parts of debt for every 0.4 parts of equity, right? So what that's 6 divided by 4. That's a debt to equity ratio of 1.5. So when you have that debt to equity ratio, that takes the beta. Sorry, I meant that I was at the wrong slide there. Yeah, you guys must have been. How come nobody said anything? So you're not even looking at what's on the slide, are you? So if the beta of, I've taught this course so many times, I'm just going right through it. The beta of the overall company is 0.95. And then you have the financial leverage. So the business risk is represented as measured by beta of 0.95. The financial risk of having the debt juicing up that return to the equity, that means that the beta goes up to 2.375. So you can see that by having only 60% of debt, you more than double the risk of the equity. But at the same time, remember the break-even EBIT curve. Yeah, more risk, but then more return. Why is it that people, when they buy, say, apartment buildings or just in general rental properties, they want to have as high as a percentage mortgage on it? It's because just think that, going back to my example at the beginning of the class, if I buy a building for $100,000 and I'm collecting $10,000 in rent on it, but I only have to put up, say, 10%. No bank's going to make you that kind of loan nowadays, but they certainly did it in the U.S. in the kind of early 2000s. You put in $10,000, you have 90% mortgage. Say after you pay your all your interest is $5,000. So you get a $5,000 return on a $10,000 investment. That's a 50% investment. Those are, anybody that can get a 50% investment gets rich very quickly because you basically more than double your money every 2 years. So, you start with 100,000, then you got 200,000, then you got 400,000, then you got 800,000, then you got 1.6 million. Boom, boom, boom. You went from 100,000 to 1.6 million in 5 years. So, just understand that concept that debt increases the risk of the equity, but at the same time, it increases the return that you make. So next, I think might be time for a break here. Okay, it's 7:30. Let's continue. One thing I forgot to say in the beginning when I was talking about the books, you can buy this book right now for $10 cash if you want. You have $10 on it, or I'll bring them back next, because my cost was, it's like $6.50 shipping, and I think they're used, they're not new. From Amazon, I think I paid $1 or $2, so my cost was maybe $8 or $9. And so anybody that gives me a $10 bill or a pile of loonies gets that book. I got 3 copies. If you don't have the cash now, I'll just bring them back. I'm not trying to make money off you guys. I'm just trying to help you get a job, because you're gonna have. I feel for you, because I was lucky. I graduated at the right time when I was your age. But sorry to say, but you're gonna have a pretty tough time. It's a really difficult time out there, and you got to do everything. It used to be, I had my job lined up. I graduated in April, and I had the job lined up like November, December before that. So nowadays it doesn't quite happen that way. So anyway, just if you're interested, I'll bring him back next time. $10. That includes tax. So now let's continue in developing the theory of Modigliani and Miller. So first we did the simplified case where there was no taxes and no bankruptcy. So then and that was the real, there's some sparks of insights, but the genius of the approach was that to figure out these formulas in the very simple case, and then build up the complexity from there it's like playing that game where you have like that big pile of blocks and you pull them out one at a time. That's essentially what they did. They made things very simple, and then they just relaxed the assumption of there are no taxes. So then they're slowly getting closer to the real world. So now in case 2, taxes exist. Well, they say corporate taxes exist, but there are no personal taxes. It gets a little bit more complicated with personal tax, but not that much. But at least for this course, we're just doing the company is paying corporate tax. But still, we still have that bankrupt. A company cannot go bankrupt. So we're still going to have. So now we're in case 2, but we're still going to have proposition 1 and proposition 2. Proposition 1 is about the company's value, and proposition 2 is about the company's cost of capital. So in case 2, interest is tax deductible, and that's true as far as I know in all Western tax system. I'm not sure how the income tax system works in China or in South America or places like that, but at least in the U.S. and Canada and the U.K., all these kinds of places, when a company pays interest on its debt, it's a business expense, and so it reduces your tax payable. So when a company has more debt, that reduces your tax, because say if you had $10,000 in income, in taxable income, but you had $5,000 of interest payment, then you would only be paying income tax on $5,000, not the whole $10,000. So the reduction in taxes increases the cash flow of the company, the total cash flow. Remember, we had cash flow to shareholders, cash flow to creditors. Well, that increased the cash flows overall. And then how does an increase in cash flow affect the overall value of the firm? So right now we're in case 2, proposition 1. So if you look at this example, you have EBIT in both the company with the all equity company, meaning unlevered, and the levered company, meaning with debt. They're both making through their operations $5,000. So their earnings before they pay their interest and their taxes. So they've covered the depreciation, but their earnings before the money that goes to the government and the money that goes to the debt holders is the same amount. So the business operation is actually the same. When we talk about business risk versus financial risk, the business part between those two companies is identical. It's generating the same amount of cash flow. But in the case of the levered firm, if you pay $500 in interest, then your taxable income is only going to be $4,500. The tax is going to be the same in either case, the percentage, but 34% of 5,000 is 1,700, and 34% of 1,530. 34% of 4,500 is 1,530. So you can see that the $500 interest payment reduced your tax from 1,700 down to 1,533. And so the net income is 3,300, and therefore when you don't have debt, you just have equity. That's all of it goes to the shareholders. 3,300 of it. In the case of the levered firm, 2,970 is the net income, but you had that 500 of interest on top of that. So the total cash flow to overall both the shareholders and the debt holders put together is 3,470. 2,970 goes to the shareholders, 500 goes to the bondholders. So the total cash flows to the providers of capital of the company goes from 3,300 to 3,470 by having that $500 of interest being tax deductible in computing your income. So you can see that as a company has more debt, the overall cash flow to its providers of capital, to its investors, both equity and debt, actually goes up. That's the key point in case 2. So I think that's an example continued from before. You have a company with 6,250 of 8% coupon debt. So the interest tax shield. Remember we talked about in chapter 2 the CCA tax shield, right? Because the CCA is a deduction against your taxable income. When you have this CCA deduction, it creates a tax shield, meaning it reduces your tax payable. We now have a similar concept called the interest tax shield, and it's because the interest deduction instead of the CCA deduction will reduce your tax. So in this case, it's called the interest tax shield instead of the CCA tax shield. So it's just the tax rate times the payment. So if you have 6,250 in debt, 8% at 8% coupon, you pay $500. We're still in the same example as the previous slide. So you pay $500 in interest. Therefore, the amount of tax that you save is $170. Look at this, $3,300 to $3,470. So the difference between the value of the company in the case of the unlevered firm versus, the cash flow between the unlevered and the levered is $170, and that is what is called the interest. The interest tax shield. Now, remember that there's 3. It's the same as it works in CCA with depreciation. You have the CCA expense. You have the CCA deduction, which creates a tax shield for each year. But then you have the present value of all those tax shields each year that are discounted back to the present, and that's called the present value. In depreciation, it's the present value of the CCA tax shield. In this case, it's called the present value of the interest tax shield. So what is that? The present value of the savings. So you just assume that it says perpetual debt for simplicity, meaning that your debt's not term debt, like you got to repay the principal in 5 years. It's just bonds that you're just able to roll over, so it's debt that never matures. Mexico is close to that. I think I heard last year that Mexico issued a 100-year bond, which I never heard of before. I'm pretty sure that's 100 years or 50 years or some ridiculous long amount of years, because normally normally in say the U.S. and Canada, you have 1 year, 2 years, 3 years, 5 years, 10 years, and then sometimes you have a 20-year and maybe a 30-year bond. I don't think Canada even issues anything past 20 or maybe even 10 or 15. The U.S., they have the 30-year bond. Nobody wants to buy that now because given the interest rate is being so low. If you buy a 30-year bond, you're just gonna, once the interest rate go back up, you're just gonna lose so much money. But in any case, we're just this is debt. Let's just imagine the number is so far into the future, it doesn't matter whether it's 100 or 1,000 or 1,000,000. So in that case, we have a perpetuity, right? The value, every year you save $170 in tax from having that interest tax shield. What are you going to discount that cash flow at? You're going to discount it at your cost of debt because it's of the risk of the debt. And so the value of that interest tax shield, so the value of saving $170 every year forever, discounted at 8%, that's worth $2,125. So that's the similar concept to the present value of the CCA tax shield. That's the present value of the interest tax shield. And if you write it in formula, you have that the interest tax shield that you pay is the amount of debt that you have times the cost of debt times the tax rate. That's what's happening here. You have the amount of debt that you have times the cost of debt times the tax rate. You get 170. But then you have to discount that at the cost of debt. So you have a cost of debt at the top of the fraction and a cost of debt at the bottom of the fraction. They cancel each other out. And you're left with the present value of the interest tax shield is just the amount of debt that you have times what the tax rate is. So in this case, if you just recalculate directly like this, you have $6,250 in debt. You multiply by the tax rate of 34%, and the present value of the interest tax shield forever, remember perpetual bonds, is 2,125. So the increase in cash flow is exactly equal to the increase in the interest tax shield. That's the advantage of debt in a company. The reason why debt is much worse, or at least one of the reasons that it's much worse in personal, is because you don't have that deduction. You only get to deduct what you pay the interest on debt when it's for business purposes, not to buy yourself a nice car or buy a house or go on a vacation. When it's a company that uses debt to buy something, they get that tax advantage. When it's personal, you don't. So that's one of the reasons why it makes a lot more sense when companies have debt versus personal debt. Because personal debt, you don't have that interest tax shield. You got to pay the whole thing and you get no deductions for it. A simple example of interest tax shield. So it's just debt times the cost of debt times the tax rate. In this example, you have $250,000 of debt. The cost of debt is 7%, and the tax rate's 35. So the numbers are pretty similar, but it's not the same example we're doing. So this is not the present value of the interest tax shield, it's just the interest tax shield for a single year. Right, it's the same as when you have CCA versus for 1 year versus present value of CCA over the life of the asset. So let's talk about what is the value of a company in case 2. So we're talking about case 2, tax, no bankruptcy. Proposition 1, value of the company. We're going to talk about Proposition 2 later, which is what is the cost of capital. So the value of a levered company is going to be the value of the company with no debt plus the present value of having that extra cash flow from having the interest tax deductibility. And therefore, the value of the equity is just going to be the enterprise value minus the value of that debt. Again, perpetual cash flows. The value unlevered, you still have the, before when you had, in case 1, it was EBIT divided by RU. Because if tax is 0, right, if you have no tax, then T is 0. And so the cash flow that you have, the after-tax cash flow is going to be just EBIT. But in this case, the after-tax cash flow is going to be EBIT times 1 minus the tax rate. Remember that you're going to see that 1 minus T thing in this course. There's a big part of 2505 versus 2504. We kind of do the Mogliani-Miller trick a little bit. Is we say, oh, we're just going to go through the chapters and we're just going to do the parts where there's no taxes. Because it makes things so complicated. And then in 2505, what we do is we kind of go back, we kind of backfill, and then we look at all the different things we looked in 2504, and we had the affected taxes to see what happens. Well, what happens is pretty simple. You're just multiplying by 1 minus T. To convert from, remember that, to convert from something pre-tax to after-tax, you just multiply by 1 minus T. If you have an after-tax amount and you want to go up to pre-tax, you just run that backwards. You just divide by 1 minus T. So that's why you see that 1 minus T in so many formula, because what it's doing is it's converting something from pre-tax to after-tax. And so in case 2, but you have no debt, you're unlevered, your after-tax cash flow is EBIT 1 minus T, and then you discount that cash flow at the unlevered return, because you're in the unlevered part of the capital structure right now. So the value of the company is just that. And so if you want to know what is the value of the company with debt, the value levered, you just take that value with no debt and you just add the interest tax shield on top of it. Sorry, the present value of the interest tax shield on top of it, which is D times T. RU is the cost of capital for an unlevered firm, and that's equal to RA. That sentence doesn't make sense. And then VU is the present value of the cash flows from the assets, so that's this part. So here's an example. You have the value unlevered is going to be 25 million times 1 minus T. So if you have a company that's making 25 million in EBIT, and the tax rate's 35%, and the unlevered cost of capital is 12, then that company is worth 135 million. Now, if on top of that, that same company is still making the 25 million, the business of the company has not changed at all. It's just there's some financial engineering going on now where you have some debt instead of just having just equity. The company, its core business is still going to be worth 135 million. But now because of the savings from the interest tax deductibility, you're going to get, the company is going to be worth now 161 million. And so what happened is this. You went from a company that, I'll ignore the decimal for now. This is actually, in case 1, it didn't matter how you sliced the pie was always the same size. In case 2, if you have debt, then the pie goes up to, the total value now is 162 million, of which 135 is the value of the unlevered, the value of the overall company is 162. You have 75 million of debt. And so you just, remember V is equal to E plus D. And so if you want to know what is E, you just run this backwards. So E, in this case, would be worth 87 mil. So that's the idea of case 2, the value of the company. As you add debt, the pie actually goes up. The size of the pie goes up. In case 1, it was the same size, but then in case 2, as you add more debt, the company ends up being the total overall debt and equity put together ends up being worth more because of that interest advantage. So this is what's happening. If you're in case 1, no matter what the debt that you have, right now they're not using debt to equity ratio, they're just using debt. That's really the picture would look about the same. So what's happening now is think of it, the core business, the unlevered company is always there, but the more and more debt you have, the bigger and bigger of a tax advantage you have, and therefore the more and more is the company worth. And you can see that that part that it's worth more than is exactly the present value of the interest tax shield, right? Which is D times the tax rate. So that's why the overall value of the company, so case 2 proposition 1, is this equation at the top. It's always VU plus how much savings you get from having the interest tax deduction. So, and that just goes up forever. And therefore what happens is, you're thinking, well, that makes no sense, right? Because if I have a company, I would just want to have, if my company is worth more when I have more debt, what's going to happen? People are just going to, find all the debt they can and go, put on as much debt as possible. Well, what happens then? Well, there's a few examples first, but I'll give you the punchline. What happens is we then get into, well, let's put in bankruptcy, the risk of bankruptcy. And so, yeah, you get more, the more and more debt you have, the more and more of that interest tax deductibility you get in your overall cash flow, but you increase at the same time the risk of bankruptcy. So you'll see that when we get to case 3, that curve actually bends down. And there's 2 balancing forces, right? Economics is all about, a lot of times is about equilibrium. What happens is you have 2 balancing forces. You'll see that in a second. You have the force of the interest tax deductibility, which brings up the value of the company, but then at some point, the risk of bankruptcy brings the value of the company back down. Because nobody wants to own a company that's 99% debt, because that's, they have one bad month, not even one bad month, maybe one bad day, and the company's bankrupt. So let's just do a few examples here. Yeah. So the value unlevered is going to be the after-tax EBIT divided by the discount rate, the unlevered cost of capital. Oh, one thing, I remember now why I picked this example. One thing you have to be careful about is when you read the text of a question like that, is it giving you EBIT or is it giving you EBIT times 1 minus T? That's why I picked 2 examples. The next one, in this one, it's, I think maybe it's the one after that. See, that one has EBIT of 250,000 and after-tax net income of 165. What that means is EBIT is 250, and then EBIT times 1 minus T is 165. That's why I picked those 2 examples, because there was a variation. You got to be careful when you read a question. Read the text carefully and know what number is it giving me. Is it giving me just EBIT by itself, or is it giving me the whole top of the fraction as a single number? In this case, the whole thing, it's not 125 times 1 minus 34%, because the 125 already includes that 1 minus 0.34 factor in it. So the unlevered cost of capital is 13. And so the overall value of the company, the unlevered value of the company is going to be 961,538. Next is the example of the value of a levered firm that has debt in it. So the value on levered is you have 200,000 shares, and they're worth $20 each. So the value of the company with no debt is $4 million. And so the value of the company with the debt, VL, is going to be VU plus the value of the interest tax shield. And so that's equal to the 4 million plus the amount of debt that the company has is 1 million. And the tax rate's 34%. And so by having 1 million of debt, it took the company from being worth the overall enterprise value, debt and equity put together, from 4 million up to 4.34 million. So having that 1 million of debt makes the overall company be worth 340,000 more because of that extra cash flow from the tax savings. So then the next one, if I go a little too fast, you can always look at the notes which are posted on the website and on lemma.ca and on CU Learn, or you can look at the YouTube video. Should be up by the weekend. So the next example, it's actually just the same thing as I did before. So I'll skip this one. You can do it. Try it yourself. That's a nice thing to try. This is a nice question to try in preparation for the quiz next week. So I'll leave it for you to try yourself at it, and then you can check your answer with the notes. So next, that's another one. This one is that one. And that one, I think what I did is I used to have those as extra examples, and I brought them into here. But all those, that one, this example, and this example, they're nice ones to try. I've already done similar ones earlier in the class, so you can try them later. You can try them by yourself. It's a good way to study. So next. So next, now we've talked about case 2, proposition 1, which is what is the value of the company when debt is involved. Now what we're going to talk about is what is the average cost of capital when debt is involved and that interest is tax deductible. And what happens is hopefully should recognize the formula from chapter 14 for the average cost of capital. Right? It's the weight of equity times the cost of equity plus the weight of debt times the cost of debt converted to after tax. So what you want to do is you can take that and you can solve for the variable RE, the cost of equity. So this equation to that equation is just, bring in that on that side. WACC becomes RU. Reorganizing it, and you end up with the cost of equity is the unlevered cost of assets plus the spread of the unlevered cost of assets on top of debt times the debt to equity ratio converted to after tax. So the example we had from before, which was the one where I had 161, like this one here. This one here, so this continues that example. In this case, the cost of equity, so when you have, actually have a picture, yeah, right there. So this is what happens. The cost of equity still goes up because, whether you have tax or not, the smaller part of the capital structure is equity, the more risky that equity is because there's more debt holders in front of you. So the cost of equity is still going to go up the same as it did in case one. But what happens now is instead of the average cost of capital being flat, because the more debt you put on, you get, first of all, you convert from, if you're paying 10% on your debt, but you have a 40% tax rate, well, you're not really paying 40%. You're not really paying 10%. You're only really paying 6%, right? That's the pre-tax cost of debt versus after-tax cost of debt. So what that does is it means that the more and more debt you have, the lower and lower your average cost of capital goes. Now, in this picture from the textbook, it's on page 494, it looks like, that average cost of capital kind of flattens out over here. But it's actually not true. It just keeps, if you're going to extend it's not doing this. So you have your cost of debt, and then it looks like, the average cost of capital starts somewhere, and then after a while, it's just parallel to it. That's kind of what that picture looks like. But essentially, what's actually going on here is this. Again, with the calculus, sorry, but it's one of those asymptotes. Right? It just gets closer and closer to it. Because think of it. If your company was 90% debt, 99% debt, then eventually your average cost of capital is the cost of debt because it's a weighted average. And if you do the weighted average between, you put a 99% weight on one thing and you put a 1% weight on the other thing, well, obviously the average is going to be mostly that first thing. So as you go towards more and more debt, on that picture it looks like after a while here they're parallel, but it's actually an asymptotic relation where the average cost of capital gets closer and closer to it, but never actually touches. But anyway, that's what it looks like. So let's do an example. And this is just chapter 14, but I'll do it quickly anyway. So it's the cost of equity, weight of equity, cost of equity, weight of debt, cost of debt, 1 minus the tax rate. So what is the weight of equity? You have 42,000 of equity, and you have the total value of the company is 42,000 plus 18,000. So that's 60,000. The cost of equity is 11.6. When I run a little short on space, I just use K and M for 1,000 and million. Oh, I'm really short on space. The cost of debt is 7.5. Now, can somebody tell me why the cost of debt's always going to be lower than the cost of equity? Because you would think that whole relationship, that whole thing would blow up if it was the other way, right? If RD wasn't above RU, then this thing wouldn't work. Can somebody tell me why RD is always below RU? Or always below RE? What's less risky, to own the bonds of a company or to own the shares of a company? To own the bonds. Therefore, what's basic finance? Less risk, less return, or more risk, more return. Therefore, for the same company, the debt, the percentage on the debt, the cost of debt is always going to be below the cost of equity for that company because the debt is less risky because you get paid first before the shareholders see anything. So that's why the cost of debt is always below the cost of equity because it's a lower risk investment and therefore it has a lower percentage. So in this case, you just put everything together, you end up at 9.61%. So it's never going to happen where you have, say, a cost of debt of 12 and a cost of equity of 8. It just doesn't make sense, right? Why would somebody accept an 8% return on equity that's more risky than the 12% return on debt? No, at least nobody that gets to keep their money makes that investment. So the second last example for the day, for case 1 and case 2, you got some math stuff. When we get into case 3, you'll see there's not actual math involved because you can't really exactly specify what the cost of bankruptcy are. So I got 2 more examples, and then the rest of it is just qualitative slides. Okay, so we'll do those 2 examples, then we'll take a short break. So the levered cost of equity, is that the one I'm at? So, yeah. RE. So that's the equation from taking the average cost of capital equation that you're familiar with and turning it inside out to get the cost of equity. We get that. And so this problem here is just about plugging in those numbers into. So now this is case 2, proposition 2. Right? We have taxes and we're looking at the cost of capital, not the value of the company. You have 600 of debt, and if you have 1,400 if the whole company is worth 1,400, then the equity is worth 1,400 minus 600, and then you convert to after tax. 17. So you can see that at 600 a debt, the cost of equity went from 15 to 17.93. And so the more and more debt you have, the higher and higher the cost of equity would be. So the next one is, that's one of those, what I would call kind of intermediate kind of level of questions. This is what I would call a basic kind of level of questions where all it is just, here's the formula, plug in the numbers, you know, boom, you're done. The next one, this one, is about, you start with the same formula. So now, before we knew all these different things, and we want to know what is the cost of equity. Now we know the cost of equity, we know the unlevered cost of capital, and everything else, but we want to know what is the debt to equity ratio. So what you need to do is take this formula and rewrite it to write the debt to equity ratio by itself on the left side and everything else on the right side. Then you can plug the number. So that's why I call it an intermediate type of problem. It's not just straight plug in the numbers. It's first you got to reorganize the equation with some high school math and then plug in the numbers to get where you want to go. So I can rewrite that as, okay, so let's start with RE minus RU, just take the RU on that side, is going to be equal to RU minus RD times the debt to equity ratio. And then you have, 1 minus T. So next, remember we want to isolate the debt to equity ratio. So let's divide through this part, and what's going to happen is I'll just end up writing the thing the other way. So debt to equity ratio is here, and then RE minus RU is at the top, and you have RU minus RD 1 minus T at the bottom. And now you have, what am I looking for expressed in terms of what do I know. So now you just get to the plug-in part. And then you just use your calculator and you get to 0.63. So what's happening here is at the cost of equity is unlevered, well, that's 12.5 is here. That's this point here. The cost of equity is 14. So when the cost of equity is 14.34, then the debt to equity ratio is equal to 0.63. Okay, so here's a good point to take a break. Okay, so the last part of today's class is going to be pretty simple. It's really just about talking about case 3, which is now we have bankruptcy cost. And so remember, in our increasing level of complexity, we started at we started at, well, there's no taxes, there's no bankruptcy. Then, one at a time, we relax the assumption of, okay, now there are taxes. So then what we're doing in case 3 is pulling out the other pin. Now a company can also go bankrupt. So what it does is, as the debt to equity ratio increases, so meaning more and more of the company is financed with debt, so you go, say, from having no debt to the capital structure being half debt, half equity, to being 3/4 debt, 1/4 equity, to being 90% debt, 10% equity, and so on. The more and more debt you pile on, here's the difference. Debt holders, you have to pay them no matter what. They don't care that you had a bad month or a bad year or employee quit or whatever. The bank still wants their money. The bondholders still want their money. They're still going to get paid. And if you don't pay them, they're going to take you to bankruptcy court and they're going to put your company into bankruptcy. Then they're going to say, we're going to take your assets. You got some computers, some cars, some trucks, a building, whatever. We're going to sell that and we're going to get our money back. That's how debt people think. Shareholders, you might say our dividend is this much every quarter, every month, or every year. But if you have a bad year, you're not legally required to pay the dividend. If you don't, the value of your stock's going to go way down. Because if you look at, you're going to get into this more in third and fourth year, what we call event studies. If you look at a company that, say, announces a dividend cut, look at their stock price. It's going to go, like the news of a company not being able to pay its dividend. While as a shareholder, you can't take a company to court and say, you have to pay me the dividend. If you don't pay me the dividend, I'm going to take your stuff and I'm going to sell it to get my money back. You can't do that with shares. Debt, you do. So as you have more and more debt, what happens is you have more and more interest payments that are due. And so if you don't make enough EBIT to be able to pay those interest payments, you become bankrupt. That's what we mean by, as the debt to equity ratio increases, the probability of bankruptcy increases because your interest expense goes up. The more debt you have, obviously, the more percentage of your capital structure is financed with debt, the higher interest payments are going to be. And therefore, the higher risk it is that you go through a bad patch and all of a sudden you don't have the money to pay those interest payments, then the... Hey! Oh. Let's just lock for... If you leave, you can't come back in. I was just going to say, like... kind of... That would have been a nice story in the newspaper, right? Cops lock students. It's like the Walmart workers. Okay, so the increased probability increases the bankruptcy costs. What are bankruptcy costs? Here's the thing about case 3. You can only talk about case 3 in qualitative terms. You can't really put equations on them because bankruptcy costs are things that you can't really define mathematically precisely. Here's an example of a bankruptcy cost. I buy equipment for, say, $1,000, but there's the risk that in 3 years from now or 5 years from now, I go bankrupt and I have to sell that equipment into a forced liquidation. You know, the example of the restaurant. Restaurant goes bankrupt, they're not going to get 100 cents on the dollar for the equipment that they bought. You know, like I said, usually the number is like 10, 15. So you buy something for $1,000, then you sell it for 100. Well, guess what? You lost by being forced to sell the asset. You lost 90% of its value. That's a bankruptcy cost. Having to sell the asset to raise cash to pay back the debt holders. That difference between what you bought something or what it's worth now, the fair market value, versus what the forced liquidation value is. Forced liquidation is always a lower value than fair market value. And the kind of progression of what things are worth, you have forced liquidation. I gotta sell today, and so you go and you sell something on eBay, and you put in a 1 day window. You might get like, oh, I'll give you 5 cents. Oh, somebody else will say I'll give you 7 cents. Right? What happens is then the next one is orderly liquidation. Right? That happens with companies that business owners that want to retire, but they can't pass on the business to their kids, or they don't know that a guy like me exists, that you can come see me and I'll sell your business for you, or it's just not good enough to sell. Then what they do is they do what's called orderly liquidation, right? You're not like forced to sell things quickly, so you might in that case get 20 cents on a dollar, 25 cents, 50 cents, whatever, or maybe even more. Like if you're patient enough, you put something on eBay long enough, eventually you'll get a pretty decent price. But if you put something on eBay and you take the first bid in the next hour, you'd be lucky if you get 5% of the value. And so one of the major bankruptcy costs is, what is that difference there? And obviously when it's a forced liquidation, the bankruptcy cost is going to be much higher. So what happens is the increased probability increases the bankruptcy cost. Another bankruptcy cost that you don't know, like I said, I can't talk to you about this in formulas. I can only talk to you in text. When you're doing a business, what is going to be the cost 5 years from now, 7 years from now to hire a bankruptcy lawyer? Nobody knows, right? You know what you pay. I'm going to buy $500,000 worth of equipment. I know what that is. I'm going to raise debt at 8%. I know what those numbers are. The problem with case 3 is you can't really put a formula on what those bankruptcy costs are. So even though, now there's direct costs of bankruptcy, all these things, and indirect bankruptcy costs. You can just read about those in the textbook. Because I could read the slides for you, or you could just read the slides yourself and read the textbook. That's just going to do the same thing. So, where's the picture I was looking for? Yeah, here's the picture I was looking for. So, in case 1, when we ignore taxes and we ignore bankruptcy, it doesn't matter how much debt you have, the company is always worth the same. Then in case 2, when we introduce the taxes and the interest tax shield, the more debt you have, the more tax saving you're going to get from that interest tax shield. So the more and more the company's worth. So that's case 2. What happens with case 3 is the bankruptcy cost of financial distress costs is the more and more debt you have, the higher and higher chance you're going to have of going bankrupt. And so what it does, it ends up bending that curve. You got two forces in equilibrium. One is a force that as you have more debt, it increases the value of the company. And the other force is as you have more debt, especially as you get closer and closer to almost all debt, that increases your risks of bankruptcy. And so the force of the bankruptcy costs bends the curve back down. And so at some point in the middle is where you reach the maximum value of the company. Because if case 2 was the way that the world works, then every company would have 99.9999% debt, because that's how you maximize the value of your company. That's kind of what the banks were doing. The whole too big to fail thing is they're saying, I don't care if I go bankrupt because the government's going to save me. So I'm just going to try to get as far this way as I can because I'm not the one that's going to pay the bankruptcy cost. It's one of those, heads I win, tails who cares because the government's picking up the tab. What do they say? It's privatizing the gain, socializing the profit. That's what they mean. That's what happened with the financial crisis is the banks stopped caring about the risk of bankruptcy, and so they took the debt way too far down the risk, and they were, you had most of the investment banks in the 80s and 90s were at a debt to equity ratio of somewhere between 10 and 15. And there's banks in the, they were just before the financial crisis, you had banks up to 20, 22, 25 times leverage. Now think of it. If you're 20 times, say if you're, going to make it even simpler. If you're 25 times levered, meaning that you have 25 units of debt for one part of equity, then if the value of your assets, and in the case of a bank, the value of their assets is the loans that they're making to people, if the value of your assets go down by 25 by 4%, 4 times, yeah. If you have, say, a $100 million or $100 billion portfolio, if those houses all of a sudden are worth if those mortgage loans are worth $96 billion, well, your entire equity boom is wiped out. That's what happened to banks. They got so close to that edge that, then there was the housing bubble popped, or at least didn't even really pop, it just started going back down. And that's why banks were failing, because they had so much leverage in them. They were financing themselves mostly with debt and very little with equity. Because the way that bank CEOs and CFOs get paid is they get, one of the measures that people look at of how a bank performs is what is the return on equity. So if you're somebody that runs a bank, and you get paid a bonus every quarter based on, say, what the return on equity of the bank is, what are you going to do? You're just going to juice up the debt-to-equity ratio as far as you can, because you know that the higher the debt-to-equity ratio is, the more you're putting a magnifying glass on the return on equity versus the return on assets. Anyway, that's the history of the financial crisis from the point of view of this chapter. So what is the optimal capital structure? It's the point at which the tax benefit from an extra dollar is equal to the increased probability of financial distress. So it's this point right here. That's in the value of the company. Now, in the case of the average cost of capital, remember that in case 2, the average cost of capital just kept going down and down and down the more debt you have. Well, what happens with case 3 is the average cost of capital starts going back up, because the more and more debt you have, the more and more risky the company is, and therefore the more and more investors want a higher return on the overall shares and stocks and bonds of the company. So at some point in the middle, there's an optimal point. Now, it's difficult to say where that point is because you don't have the equation for the part that makes the curve come back up. But realistically, just a general guideline is half and half. If you're half equity, half debt, is usually, well, depending on what industry you're in, but that's a kind of a first order approximation. Obviously, say, your utility, like you'll say like a privatized like water, you do like water, electricity, whatever, and you know that people are paying their bill like every month the same amount, and even maybe like the government regulates what the price of that utility, like the price of water is always like $30 per month. You're able to get more debt because your cash flows are more stable, so you reduce the risk of, if you know that you got 1 million customers and they're always paying you $5 a month, well, you'll know that every month you're getting 5 million, and so you're able to get more debt because you know your cash flows are more stable. There's less risk of, if your profit's going up and down quite a bit, you want a company that's financed with more equity. And so that's the conclusion. In case 1, there is no optimal capital structure. We'll be done a little early tonight. So in case 1, then you have prop 1, and you have prop 2. I could put them on the same picture. So with case 1, the value of the company, no matter what the debt to equity ratio is, the value of the company is always the same. So there is no optimal capital structure. In reality, that's not quite the right grammar there. What it should say is every capital structure is optimal because it's always worth the same. Right? It doesn't matter where you are on that line, it's always worth the same amount. In case 2, what's happening is this. Right? You go up, you have the value unlevered plus the tax shield. So the more and more debt you have, the more and more, the higher and higher the company's worth. Now, this is an error in the textbook. They say the optimal capital structure is 100% debt. I explained to you earlier that that's impossible because a company always has at least one share. So you might have, it might be 99.999999999% debt, but it could never be perfectly 100 because you're always going to have at least $1 or 1 cent of equity. Otherwise, you don't have a corporation in the sense of like English common law or like, you know, you don't have a corporation. You need to have at least one share worth at least 1 cent. Each additional dollar of debt increases the value of the company. Now, in case 3, what happens is this. The value of the company, as you go from no debt and you start putting on debt, it goes up. But then at some point, putting more debt makes the company have a higher risk of bankruptcy, so it starts to fall down. So in this case, the optimal is, you know, as far as you can go. In this case, this is something you see in math or finances. When you put a star on something like that, it means that's the optimal point. So you might see that in other courses. That's what it means. When you have, say, a variable like that, but then you have a certain point which has that variable with the star as the superscript, it means that's the optimal point on the X scale. So then if you chart the average cost of capital on that same thing, this is what happens. Here, again, same thing, doesn't change. Now, that would be on a different scale, right? Because the value, I'm just putting 2 graphs in one. So that would be in terms of dollar, that would be in terms of percentage. With case 2, the WACC starts at the same at the unlevered, and then it just gets closer and closer as you go further out. So the optimal point is, you know, as much debt as people will loan me. And then with case 3, what happens is the lowest cost of capital is going to be achieved at the same point as the highest value of the company. And that point is where the optimal capital structure is. And so it varies from industry to industry depending on the stability of the cash flows. But if you don't know what it is for your industry or the business you're starting at, a good kind of first number to look at is about half and half. So if I look at my company, I got about 500 in assets and about 200 in debt. Yeah. So, you know, I'm at about balance there. It's because you can't have you can't come up with an actual equation for what the bankruptcy costs are, and that bends back that curve. You can never just write the equation, boom, 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 solve it, and you know it's 0.625 or something. You can't do that. Same thing. There. Then there's a little couple more things, but for what is it for that extended pi model and value of the firm and those, you can just read that in the textbook. And the bankruptcy process. I know it's a painful thing to go through, but you can just read about it. And what I'm going to do is just give you one out of that chapter 60.9. I'll give you one qualitative question on the quiz. So if you don't care if you only want to get to 90% on the quiz, you don't have to read 16.9. That's it for tonight. I'll see you next week. And remember, quiz 3 is at the beginning of the class. Don't forget to read the qualitative part of chapter 16. I don't make you read very often, but that's just one of them.